built equity in your rentals, but now what? You could do a cash out refinance to pull out money for your next deal. But if you do it wrong, it could wreck your cash flow and your growth. So in this episode, I'm joined by my investor-friendly mortgage broker, Bryan to break down exactly how cash out refinances work and how to use them without putting your portfolio at risk. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson. And in this show, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. All right. So Bryan, I want to set the stage here. We have so many investors and also homeowners who have a bunch of equity in their properties. And they're looking at this equity and they're thinking about, I want to grow. I want to be a good investor who's building more wealth. And they keep staring at this equity in their home saying, there's got to be something I can do with this equity. And one tool in the financing tool belt, which you told me offline, which I didn't realize was the case, you do a lot of cash out refinances, which is what we want to talk about. So pulling out your equity from a property, and with one specific tool we're going to talk about called a cash out refinance. I want to talk about this, but I want to get into the vocabulary. Like what is a cash out refinance? Can you just kind of start really basic with that and explain it, and we can dig into it more?
Love it. Yes. So when we do a refinance, we're doing one of two types of refinances. One is called a rate term refinance, and that's where we literally don't put money in your pocket at closing. We can pay off your existing debts, we can finance in your closing costs, we can pay off any mortgages, but we're not putting cash in your pocket. And when we pay off debt, it has to be debt on the house. The other type of refinance we do is a cash out refinance. Now, this sounds strange, but if you have no mortgage on your property, it's owned free and clear, it's still considered a refinance because it's not a purchase, right? In our world, it's either a purchase or a refinance. So a cash out refinance is where we do put money in your pocket. And it's just that easy. If you get money in your pocket, it's a cash out refinance.
Got it. So you've compared it, you call it a rate and term refinance. That's one term. And then you have a cash out refinance. Those are our two choices if we're going to refinance. Right. So I'm thinking, like, what are some situations that you see? You have a lot of clients that you work with on this. What are some typical situations where somebody comes to you and says, Bryan, I want to do a cash out refinance? What does that typically look like?
Yeah, so I always tell people, I got 4 kids and I got a lot of bills and I need to save for tons of colleges, right? And so to me, equity in a home is unemployed Benjamins. It's not out in the workforce making you money to bring back to you. So a cash out refinance for a lot of investors, it's about freeing those Benjamins and getting them employed, getting them off of welfare, sitting around looking at each other in your house and putting them in the workforce and redeploying that money. That might be another house that you're purchasing. It might be a business opportunity. It's got to be, if you're doing it on an investment property, it has to be a business purpose. When you're doing it on your primary residence, it might be for future investment opportunities, or it might be for debt consolidation. It might be that I have a bunch of credit cards. Americans have $1.1 trillion in credit card debt right now. So we might just be trying to pay off existing debts, and we have a really good first mortgage rate. So we might do a second mortgage, or we might do a cash out refinance where we pay off the first mortgage and we put money in your pocket for that. So for investors, you're primarily looking at how can I put this money back to work for me? And for homeowners, for your primary residence, it could be, how do I get this money to work for you? Or how do I consolidate and pay off some other debts?
I want to linger on the homeowners who have other debts scenario. We're going to spend a lot of time on the investment side of things, but people also might be thinking about their own home. You mentioned a lot of people have high interest debt on a credit card, some other place. So even if, let's give an example, somebody has a $300,000 house, they have a $150,000 mortgage, and they come to you and they say, I have over here on the side, I have $50,000 in really expensive credit card debt, 21% or something like that. What I'm hearing you say is if you can refinance your home and pull out $50,000 worth of money at a 7% interest rate, for example, then that could be a situation where it very clearly you can use that money and pay off that debt faster and not have to continue paying 21% for a long time. Is that what you're saying in that scenario?
That's exactly what I'm saying. And when you look at mortgage debt, it is cheap to service. Like, how much does it cost per month per dollar you borrow? So every $10,000 on a mortgage is roughly $60 to $65 a month in payment. Every $10,000 on a credit card could be $250 to $350 on your payment. So we may just rapidly increase your cash flow by moving the debt from credit cards to your mortgage. That's going to vastly improve your monthly cash flow. Not to mention, the average credit card rate is over 20%. I mean, I see most people, they're in the 21 to 25% mark. If you have any blemishes on your credit, you might be at 29% on your credit card. And your mortgage, 7% is obtainable on cash out refinances, depending on your credit score. This is not a rate quote. We need to look at your situation. Even if we're going to the 8s or 9s, sometimes it's way better than credit cards. And we've got all kinds of different mortgage products that could get that money in your pocket. One thing we're going to look at when we decide, are we doing a cash out refinance or are we going to leave your existing mortgage alone, is we're going to look at what your blended rate is. What's the rate of your existing mortgage and what's the rate of your debt? And sometimes, even if you've got a 3 or a 4% mortgage, you might be better off to pay it off and go to 7% because your blended rate, your mortgage on the first and your credit card debt, you might be at the 11 or 12% blended. And if we bring you down to 7%, that's a tremendous value. Now, if we can accomplish that goal with a second mortgage, either a home equity line of credit or a home equity installment loan, we might be able to preserve that first mortgage. So there's no right answer on should I pay off the mortgage with a cash out refinance or should I tap the equity with another product?
So this first use case is more like debt restructuring. I guess we could think about it that way. We've got several piles of debt. They all have different interest rates, different risk. And what we're saying, we might be able to use one tool or one or two tools in your equity, home equity, to help you move forward financially. Because that's what I'm thinking when I hear all this credit card debt is like, you want to get out of the habit of having high interest debt in the first place. So like if you go through a cycle of like borrowing your money, paying off the credit card, borrowing your money, like that's a bad cycle. But if you can do it once when you're in a situation where you just need to get it paid off, and then that can increase your cash flow by several $100s per month, that might give you the breathing room to then have some extra cash flow to save for your rental property, to save for the next thing. So I could see that being a really good tool in that case.
And sometimes it's $1,000 or $1,500 in increased cash flow. Okay. So once we do that reset to your finances and we rebalance your cash outlay to service all your debts, the goal is we get you on a written budget. I love Dave Ramsey's book called The Total Money Makeover. The goal is to not put credit card debt back in place. Once we rebalance your debt and we move it from outside of the house to inside the house, we're going to have a lot more cash to play with. But we need to be intentional about what we do with our cash. Some should go to savings for that rainy day. Some should go towards going out to eat and buying groceries and buying clothes. But that written budget, hopefully once you reset your debt, we're on a good written budget where we don't tap back into credit cards. And maybe with a lot of clients, I'll do a cash out refinance, pay off all their debt, and then I'll put a home equity line in place on top of the cash out refinance. So if you do have an HVAC system or a roof and you don't have the savings, you're not going on credit card. You're going on your home equity, which is much easier to service and it's much better for your credit score to avoid adding credit card debt.
Interesting. Well, you've mentioned this home equity line of credit a couple times. One of the questions I was going to get into was, what's the difference between a cash out refinance and a home equity line of credit? And what are some just basic pluses and minuses of those two things?
That's a great question. So a home equity line of credit, think of it like a big credit card that's attached to your house. So we're going to have limitations on how big of a line of credit we can get you based on your income, your debt to income, and the equity that's available in your house. And you pay based on what you use, just like your credit card. If it sits at zero balance, you don't have a payment on your credit card. Same with the home equity line of credit. It's a line of credit. So if you have zero balance, there's zero payments. But it's there ready for you, ready to be used instead of your credit card, right? Maybe you go use your credit card to buy the roof because you get points, and then you pay the credit card off at the end of the month to your home equity line. Most home equity lines of credits have interest-only payments. Some do have a percentage of the outstanding balance, but the home equity line of credit's main purpose is not to touch your primary mortgage. And we could do a whole show just on home equity line of credits, and we probably should at some point.
We will, yes.
Right? Because there's so many differences in there. But essentially, a cash out refinance, we're going to pay off your first mortgage, or if you have no mortgage, we're going to do a fixed term loan. It could be 15 years, 30 years, but it's a fixed payment. The rate is fixed most of the time. We can do adjustable rates, but that's not commonly used right now. But we're going to give you a bucket of money and you're making payments on it based on day one, based on your balance and your amortization schedule. The home equity line of credit, you could use it now to pay off some debts and have some extra available. You might put it in place when you don't need it. That's always the best time to get a home equity line of credit, when you don't need it. Because sometimes when you really need it, it's too late. You can't get it. Yeah. If you got laid off, Can't go get a home equity line. Wish you had it last week, right? To cover some expenses while you're finding a new job.
So for people who are investors thinking about investment loans, while we're talking about lines of credit, we talked about home equity line of credit, like the home you live in. Are there products out there where an investor can also use a line of credit on their equity as opposed to just doing a cash out refinance?
Yes. Now, if you go to your local bank, they'll probably say no. It's probably 1 or 2% of banks will do a home equity line of credit on an investment property. I have 17 different lenders that can do home equity lines of credit on investment properties. And we have a lot of different choices on underwriting. Is it a full doc, W-2s, tax returns, and pay stubs? Is it a bank statement where maybe you have that magic CPA that makes your business look like it earns no money? Or we even have DSCR, or debt service coverage ratio, home equity lines of credit. So the line of credit payment and the first mortgage payment are calculated against your rental income, and there's no other income docs that I get from you, and we don't care what your other debt is. We're looking at just the house, its income, and the payment with your first and your second mortgage or your home equity line of credit.
Interesting. So if I had to summarize this, correct me if you have a different view on this, Bryan, but you have cash out refinance, you get all the chunk of money right now, you use that chunk of money to pay off your old debt and then pull out some money to do something else with it. We're going to talk about what else you do with it. That's so you get one chunk of money one time right now, then you start paying interest on it. Lines of credit, you have the opportunity to do that. They open it up and say you can get up $100,000 or whatever your number is, but you could write that check now. You could get that money 3 months from now, 6 months from now, and you could pay it off and borrow it like a credit card. So yes. It's really the difference is in how you win and how you get the money, and also there's some different terms. Is that kind of one way to think about it?
That's actually a great way to think about it. The home equity line has flexibility, sometimes in payment and in usage, where the fixed mortgage, it's pretty set in stone. And the home equity line, you made a good point. You can borrow it and pay it back and then borrow it again. Right? It's a revolving line of credit like your credit card, where if you did like a fixed second mortgage, you get a bucket of money just like the cash out refinance. But once you pay it back, it's gone. It's done. And sometimes that's better. Sometimes having some flexibility with the line of credit is better. When we look at lines of credit on houses, investment properties, typically speaking, have a 3 or 5 year draw period. So that's how long you can advance money back off of the line of credit. On a primary residence, it's usually 10 to 20 years as the draw period. And I do have some products that are 30-year draws on both investment and primary homes. So you can use that line of credit in and out. But it's a first mortgage position, so you have to pay off your existing first mortgage.
I love how every time I talk to you, Bryan, you're like, I've got all these different options, and that's what's really cool. Is I had no idea there was 17 different lines of credit for investor banks out there, but you've always got the latest of what's going on. So that's enlightening.
And if I find something I don't have, my company goes and gets it for me, so that I'm always kind of trying to stay at the front line of options for my clients. Right? Because that's the important part. It's just, if you go to a direct lender, they've got one option and you either fit or don't fit. Yeah. But I've got 16 backup plans if the first lender, if it didn't work out, right? So working with a broker is oftentimes going to be advantageous. Now, when it's a primary residence and you're doing a home equity line, I'm usually not best. If you have income that you can verify with W-2s and tax returns, your local bank or credit union, honestly, is going to be cheaper than me. I'm going to have more closing costs than them. So I oftentimes tell people, if it's for your primary home, check with your bank or your credit union. And if you can survive underwriting, because they're tougher to underwrite, if you can survive underwriting, go with them. If you can't, then I've got some different options that banks can't do. I can go higher on your debt to income. And oftentimes I can go higher on the loan to value, how much equity we're tapping into. A lot of banks are going to be at about 80% max. They call it combined loan to value. So it's your first mortgage plus your HELOC. And many banks will go to 80%. Some banks will go to 85%. And some credit unions will go to 90 or 95%. And I've got some lenders that can go to 90 or 95% on the primary residence side. On the investment side, we can go up to 75% with many lenders and 80 or 85% combined loan to value with a couple lenders. So we've talked about it before, but there's no best product. It's just what tool is best for your situation.
Well, I want to dig into some more of these mechanics and like the actual way cash out refinance works. And then the next thing we're going to get into for those listening is talking about strategy. How to use this? What should you do with the money? When's it a good idea? When's it not a good idea? But let's just start with I'm coming to you, Bryan. I'm decided I want to do it. What should I think about? You mentioned a couple loan to value type criteria, but what are some of the criteria that a lender is going to look at me and say, is this a good person to loan the money to? Is this a good property? And is this not? What are you looking at for a cash out refinance?
Yeah. So the first thing is going to be the value of the house compared to the debt that's already on the house or the debt that we're planning to put on the house. So your loan to value. So that's just how much loans versus how much value, and trying to see what's appropriate for your situation. If we do a cash out refinance with Fannie Mae in a primary residence, they'll only let us go up to 80% of the value of your home. So sometimes a line of credit or a second mortgage is better for your situation if we need to go higher than 80%. On an investment property, your max cash out loan to value for Fannie Mae is 75% of the value of the home. If it's a single family property, if it's a 2 to 4 unit property, 70% is the max on the cash out. What we're also going to look at is income and credit scores. So those are the main three kind of determining factors of what can we do for you, Chad. Where's credit scores at? Because if you have a 600 credit score, we're going to have very, very limited or no options for cash out refinances or for lines of credit. If you've got a 780 credit score, we're going to have all the options open in the world. So sometimes our limitations are based on where your credit's currently at. Sometimes it's based on your income. If I can't prove enough income, I have to lower the line of credit to get within guidelines. Many lenders allow for us to go up to 50% debt to income. So debt to income is how much payments are you going out versus how much income is coming in. And so we're going to look at your debt to income, your credit score, and then how high or how much equity you want to tap. And those are the things we're going to talk about to determine what's the best product for you. Once we learn about your first mortgage, we're going to decide, is it best to pay off that first mortgage and just do one big new loan? Or should we try to preserve your first mortgage if possible?
Yeah, I want to talk about that. So one of the elephants in the room, and every market's a little bit different, but we're in a market today where people do have a lot of equity, investors and homeowners, and there's these underlying mortgages, many of them at 3%, 4%, 5%. So you're a mortgage strategist. Like, how do you think about that? Like, I'm going to give you a real example. Let's say we have I have an investment property that's worth $400,000. I have a loan that's $200,000, and I bought it 6 years ago, and so it's appreciated in value. I paid the loan down, so now I have 50% equity in the property, but it's a 4.5% loan. And I'm like, oh man, I do not want to pay that loan off. Help me think through that calculus. What kind of questions would you ask me to determine whether it's smart to pay that off or whether I should try to do something different?
Yeah, in this example, your current mortgage is half of the value, and the amount of equity we have available is probably between 100 and 150 grand. So that's how much of your equity we can tap into in most circumstances. Most of the time we can go up to 75 or 80%, maybe up to 90% loan to value if it's a primary residence. So we're going to look at what's the interest rate of the new loan we're doing if it's a second lien position. And when we do second lien position loans, it can be a home equity line of credit or a home equity loan. So it works just like your first mortgage where it's a set term and a set payment. It's fixed rate typically. And you could do 30-year fixed rate second mortgage. So we're going to determine, is this money that's going to be outstanding long-term? So we want to do a fixed payment and a fixed term, or is this money that's going to go in and out? Or, maybe your income, you get a bunch of bonuses or big tax refunds. So you can rapidly pay down this debt and then you have access to it again. That's going to be more appropriate for line of credit. So we're really looking at three things. Do we keep or pay off the first mortgage? And then do we do a fixed second mortgage like a car loan that's got a fixed payment and a fixed term? Or do we do a line of credit like a credit card that we can go in and out of? So there's a lot of questions that we need to figure out, and how you're going to use the money, how long the money is going to be outstanding, how you can verify income, what income approach are we doing? That's going to determine on the lender, and that may determine how much access to the equity we can tap for you.
So I'm going to give you two different scenarios because it might answer our question on which we might want to go. Let's say I want to have about $100,000 to tap into to buy another rental property, and we'll talk about the details of the rental property in another scenario. But that's my purpose. Is like I don't have enough. I only have like $25,000 saved up on my own. I want to buy I feel like this is a good market to buy in, and I want to tap into $100,000. Which way would I lean towards maybe the type of refinance mortgage I'd want to look at?
Yeah, so if you're using this money to buy another house, it's probably long-term debt unless you're a high income earner or you get big tax refunds or annual bonuses. So we're probably going to lean towards more of a fixed, predictable payment, right? It's not going to be variable. It's not going to be one that goes up and down in interest rates. And we're planning on having this debt outstanding long-term. A loan is oftentimes a great option for you. The line of credit could be a good option. It allows for lower payments because it's interest only. But I worked in retail banking for 17 years. I've done thousands of home equity line of credits in my day. And overwhelmingly, if someone gets an interest only payment, that's all the payment they make. They're not paying extra. And if we want to have that debt outstanding long term, that might be fine. But if we want to be chunking down, we may want to be more aggressive and have a fixed payment on a term loan instead of an open-ended line of credit with interest-only options.
So I might lean, because I'm going to be buying an investment property, I want to stabilize that cash flow, have a longer fixed rate than maybe going. So I might, in that case, I'm going to get a loan instead of a line of credit. How do I decide whether to get a second mortgage or just get a new first mortgage that pays everything off? That's another choice I heard you talk about.
Yeah, so we're going to look at the rate based on your credit score, based on your underwriting scenario, and based on the lender we go to. We're going to see what the rate is. And let's just say we do a second mortgage. Let's say, Chad, this is your primary residence and you got great credit and you have easy to verify income. We might be in that 8%, maybe 9% on the rate. So then we look at, we're going to calculate what we call your blended rate. So if your first mortgage is, I'm going to do really simple math here. If your first mortgage is 200 grand and you're paying 4%, and your second mortgage, we do 100 grand and you're at 8%, right? We know that we're going to use 2/3 of your first mortgage rate. So 4% times 0.67. So your first mortgage is contributing 2.68% to your blended rate. Now your second mortgage, if it's at 8%, then we're going to use 1/3 of that because it represents 1/3 of the debt on your house. So times 0.33, that's also 2.64%. So we add 2.64 and 2.68. Your blended rate, if you did that second mortgage at 8%, your blended rate is 5.32%. So it would make sense to keep your first mortgage in place, right? Because you're paying, if I did a cash out refinance, today is August 6th. So when this records, the rates will be different. I'm not quoting rates. I'm giving an example for educational purposes. I have to say all kinds of weird things when I say a rate online. But let's say we did a cash out refinance today at 6.75. Well, your blended rate of 5.3 is better than the 6.75. So we decide based on simple math, you're better off to do a second mortgage and leave your first mortgage in place.
That's really smart.
Now, let's do something different because I had this phone call. This was a real phone call. I had a lady who had like a $500,000 house. She only owed like 50 grand, but she had like a 2.75% rate. And she wanted to get out a bunch of money because she wanted to buy 2 or 3 homes. And a cash out refinance, this was again her primary residence. We were going to be at the time around 7% on the rate. And she was like, well, I don't want to get rid of my 2.7, but second mortgages can be way higher in cost. So if you have a ginormous second mortgage at like 9%, I think at the time she was at 9.5%, your blended rate, I think her blended rate was going to be like 8 or 8.5%. So it didn't make sense to keep that little tiny 2.75 mortgage. We actually were spending more money to save our low interest rate first mortgage. So sometimes I say, I like that rate, but we're going to take it out back and kill it because it's going to cost you more to keep it than it would be to let it go.
Yeah. So it seems like the percentage, like if you have whatever loan you have in place, the smaller it gets compared to the new loan you're going to be getting. So if it's like 10% of the full loan you're going to be getting, that is probably it doesn't matter that it's 2%. Whereas if it's 80% of the loan, so if you're borrowing $250,000 and you have a $200,000 existing mortgage that's at 5% or 4%, that's going to probably make more sense to keep in place in that case.
Yes. As long as, and there are some instances where I wish we could do that, but you might have like a 660 or a 680 credit score, and we're not able to tap enough equity in a second lien position loan. So we might, if you've got a tremendous amount of credit card debt, we might give up that low rate, even though it doesn't make a lot of sense. It's still a net benefit to you. So at the end of the day, we really just need to look at your current debts plus your new debt and do some simple math to decide what's the best direction. How should I tap this equity? There's no best product. There's just best for your situation.
Yeah, this is why you got to sit down and run the numbers and look at all the products on the table. It's really helpful. And I think the big unlock for me there, Bryan, was just looking at your blended rate, running that calculation, figuring that out. That's why it's not a simple equation. And so if any of you call Bryan, you'll be able to sit down and kind of go through that. The follow-up question I would have is, like, it sounds like you have to have really good credit. You have a primary residence to be able to get a second mortgage to a cash out refinance. If that same property, $400,000 value, $200,000 debt, were an investment property,
Yep.
Do I still have options to do second mortgages, or is it only refinancing to first mortgages at that point?
There's a lot of options to do second mortgages, both in a fixed term loan and in a home equity line of credit for investment properties. Your second mortgage rates are going to be a lot higher on an investment property. Today, early August, you're probably in the 9s to 11s to do a second mortgage. So if that first mortgage is in the 3s or 4s, it probably still makes sense to keep that first mortgage. But if you just got this first mortgage a year ago and you're at 7.5, it might make more sense to do a cash out refinance. The good news is it's simple math and it's not an emotional decision. It's just a business decision. And we just lay out options and see what's best for your situation. But you can, on investment properties, you can tap your equity with second mortgages that are fixed or the home equity lines of credit that are variable.
Okay, got it. All right, so that's very helpful. We've talked about qualification. There's credit. There's the debt to income ratio. There's also the property loan to value. I do want to linger one more time on the debt to income, the DSCR, the debt coverage ratio, because one of the things we've run into as interest rates have gone up is you might have equity in the property. Maybe you have like 150,000 of potential equity, but then the cash flow in the property, in this rental property, it doesn't make sense because the interest rate is 9%. Has that been more common that equity is a little bit tougher to capture because of interest rates where they are?
Yeah, especially if we're doing the DSCR underwriting, right? So the DSCR is how we calculate income. And with the higher interest rate, you can't increase your rent overnight, right? It's based on what am I getting on this property. So you might want to tap that equity, but we may have some limitations. In that instance, we might decide that we've got so much equity that we can't tap because of our rent. We might decide to do a cash out refinance. We do have DSCR loans that can go under a 1.0. So if, let's say, your payment on your mortgage is $1,000 and your rent is $800, right? So you're only covering 80% of your payment with your income. So that's called a low ratio loan, and we can do that. It's a slightly higher interest rate, but if we can tap some equity and get it to work, our hope is that it's going to offset even the slightly higher interest rate. So it may mean we don't have access to a second mortgage and we may have to revert back to doing a cash out refinance and paying off that mortgage. And Chad, cost is cost, right? So if you have a 4% mortgage, you're measuring cost. Oh, I don't want my 4% mortgage to go up to 8% because there's a cost to that. But what's the flip side of the coin for cost? It's opportunity cost. If I can make 50 grand, I don't care if I'm paying double the interest because I'm going to make it up with this flip that I'm planning on doing or with this tremendous purchase that I have access to. So sometimes we have to measure the cost versus the opportunity cost to see if it makes sense to get rid of a low interest rate.
Well, that was a perfect segue because, you've had your mortgage broker hat on and we're talking about the lending side of things, but I want to think about it from the investor standpoint, which you happen to be an investor as well. And you talk to a lot of investors. I want to think about when strategically cash out refinances make sense, like maybe some examples, and when maybe we should be like, let's put the brakes on this. Probably this is not a good use of because there's some risk every time you borrow more money. I'm always talking about eventually, pay your debt off one of these days. And so there's this thought of like balancing risk and rewards. I'd love to get as you put your investor hat on, what are sell me on the idea that this could be a good reason to get those Benjamins working like you talked about earlier. And then let's go to the other side of the coin when it's maybe we should have some red flags.
Yeah. So when should we go into extra debt, right? When should we free those Benjamins? And the win for an investor usually comes down to what's the opportunity you have access to. If you're tapping equity in a house to buy a new house that has very limited cash flow upside, we may pump the brakes because it doesn't make financial sense to tap into all of our equity that we have access to, and we might put ourselves in a bind. So we really want to look at, if this money is out working for you, what's it going to bring back? Are we banking on appreciation for the properties we're buying? Are we going to flip something and we're going to have an instant gratification as soon as we finish this flip? Are we trying to grow our portfolio to a certain number? And then interest rates are going to hopefully come down over the next 2 to 3 years. Maybe we're okay having a couple of years of very thin cash flow because it's going to put us in position that once we can start doing some refinances, we're going to increase our cash flow. I have a lot of investors that they have a W-2 job. They have their income coming in and they're really looking to grow their portfolio because they know that home values, generally speaking, don't go down that much, right? They usually are going to be increasing. And so this is a good time as an investor to buy when there's opportunity out there. There's a lot of markets that there's some inventory building up. And because interest rates are a little bit higher, you have less homeowners out shopping for new houses. So we might have opportunity today to take advantage of low competition in the marketplace. So go get those properties under your belt and tap that equity, get it employed. So you might not be generating a monthly income from the transactions we're doing, but it might be putting you in position for some great appreciation.
Yeah. So I think to summarize that, the opportunity cost is if you're going to borrow $100,000 from your equity and pull that out, if you can go turn that into some multiple of that, you have a really clear opportunity to buy something else that's going to make you a lot more than that $100,000. And you can see a clear line to that. Then the reward of that extra money you can make could be worth the risk you're taking of borrowing that money today out of your equity. Is that a good summary?
That's exactly it. Yep. And it is, when you tap more equity of your existing home, you are limiting your outs, right? You can't discount your house, but so much when you have a mortgage that's going high into the value of your home. So if you're at 80% loan to value and something happens and you got to get out of that house, you can only discount it about 15% because you're going to have some agent closing costs. And that may limit how quickly you can exit that property. Or God forbid, you're in a market in Florida that has just a ton of inventory. You may limit yourself severely on your exit strategy when you tap into a high leverage position. So that's the risk part that we want to analyze. Is it worth the risk to go tap and try to chase that reward?
Yeah, I want to share a couple of thoughts that just come to mind for me, Bryan, and feel free to add some things to it. I'm thinking number one, I get uncomfortable getting too high a loan to values. Like even when I first started my career, when I was highly leveraged, I would try to be at 70, 75% in general. So I think if I'm coaching somebody, one of my first feedbacks is hey, I know you want to grow. I know you want to do this, but let's limit your loan to value. Even if you can get 80%, 85%, let's just be conservative and keep that a little bit lower. It means you pull out less money, might grow a little bit slower. But because of what you just said, I've been through 2008 and 2009, and I've seen when you have to dump a property and sell it quickly. And so that thing number one is just strategically, I just think you got to set a limit and say, even though I can do it, do I do that? That's number one. The second thing I want to highlight that you said is it really matters what you do with that money. And I'm going to give an example of what I think is probably not a great use. And maybe this is where you can discuss this with me, is if I pulled out $100,000 and I'm now paying interest on that mortgage, whether it's a second mortgage or a cash out refinance of a new first mortgage, and then I go use that money as a down payment on the next property. And this next property it's just a kind of a mediocre cash flow. It's like a long-term play. Even if that property is a good long-term play, I now have increased my risk on the first property. And now I bought another property that is pretty highly leveraged that doesn't have much. So now I have two properties with not much cash flow. And I started off with one property that did have some cash flow. And now it could be a good long-term play, but the way I've seen people go out of business is having all this opportunity, this equity, but not enough cash flow. I guess in that scenario, I'm a little more nervous. I'm saying, all right, you just use all that money for a down payment, as opposed to what if you went to a less risky deal with that $100,000? Maybe the next deal I buy is a 50% down payment, or I just pay cash for a deal, or I use it to flip houses, but then I'm paying that money off every time. I would want to go into something that's less risky than the deal I just got out of. I guess I'm trying to say it that way, because I feel like if you keep stacking these highly leveraged deals, that could end badly if things didn't work out well.
And I think it's very situational. So I was talking to somebody actually in your RPM community. I was talking to them yesterday, and they have a property that they've inherited, and it has a home equity line of credit on there. And their fear was, what if they call this note due? I don't want to go buy something else because I need to retain some cash just in case, right? So do I expand by cutting my parachute so I have no backup plan? We talked through, and there are a lot of different backup plans for his situation. So we kind of alleviated or put to bed the risk of this note gets called due and you have no options to cover that. He doesn't want to lose all the equity in this house he's inherited, right? So I like to think of it like a parachute. You might have two houses and the numbers don't make sense, but do you still have a parachute? Do you have a third house that's free and clear, or do you have a line of credit with a bunch of available credit? The global picture for you, do you have a parachute on your back or not? If you've just tapped your primary residence to the max because you can, and you put that money into a risky investment property, you just cut your parachute. And now you have no backup plan. And if 2008 happens again, you're taking massive losses and you're smacking the ground because there's no parachute. So if you've got some extra capital or an IRA or you have a backup plan, you can take a little more risk. But if you're really stretching everything to the max, man, there's no safety net below you. And that's a scary place. I try not to be judgmental and say to people like, you can do this, but should you? But my job as a debt manager for people is to get them to think about all angles. And I tell a lot of people, like, I get paid if you do this with me. If you were my brother, I'm going to give you advice that I give my brother. I wouldn't, right? So I don't say not to do it. I say, if you were my brother, I maybe would shy away from this because we're taking some risk that doesn't have the reward that's worth it.
Yeah, I like the parachute analogy. I do think it is, you can't just look at that one property and specifically, just make a judgment there. You got to have the more global picture, but you also just have to have a risk management, hat on when you're an investor. Right. You have to be thinking like, what's the worst case scenario? What will happen? And in general, that means don't pull out all the equity you can. Don't use up all the cash you have. There should always be some extra. There should always be a margin of safety in there. I think is my main message is the people I've seen crash and burn have used this is a good tool. Like cash out refinances, the tool is just a tool. You can use it.
It's not good or bad.
It's not good or bad, but the people who have burned out using the cash out refinance tool have the ones who just pressed the gas to the limit and they're gone full speed and they didn't have a governor on there to sort of slow yourself down a little bit, to listen to Bryan when he says, I probably wouldn't recommend this to my brother. This is why you can't just make decisions by yourself. You got to have a community around you. You got to have advisors. So that's a long-winded way of saying like tools are great. Use the tool carefully, right? Because it can backfire on you as well.
Well, think about how easy it was to tap equity before 2008. You could do a 97.5 cash out refinance on an FHA loan. You could do, do you remember Ditech? Do you remember the commercials they used to run?
Oh yeah. Yes.
Go get 115% of the value of your home, right? Yeah. How'd that work out for a lot of people? Not so great.
Yeah.
There's a reason that Fannie Mae on an investment property says 75% loan to value is the cap. It's a risk. They've made that determination that when they go above that, they see more default. So Fannie Mae is pretty smart at their guidelines because they're assessing risk and they don't want your house. And they know if you tap higher than 75%, there's a higher likelihood that they're going to take in your house. That's why the guideline is there.
Yeah, smart. So that's another conversation we can continue to have. But I want to, for people, they now know how to do it. They now know some of the qualifications and when it's a good use case. What I'd love to go to next is if somebody is an investor and they say, I want to try this out. Like what are some of the next steps? Like what first of all, what kinds of things should they prepare and do ahead of time before they call you and before they talk to your team and actually get into the nitty gritty? Like what should they do ahead of time?
I get so many phone calls and I'll start asking people some information. They're like, oh, I don't know my mortgage balance or my interest rate. I got to go look it up. So let's go with the very basics. Know about what you owe, right? And if we're looking at doing debt consolidation, go on Credit Karma or go on annualcreditreport.com and get a copy of your credit report so that we can be thorough. The more information you can give me, the better I can advise. So knowing about what your rate is, doesn't have to be exact, about what your rate is, about what your balances are, and what you think your house is worth. Zillow is a great tool. It's a tool, but in their fine print, they say that this could be 20% high or low. That's a 40% variance on what Zillow thinks your house is worth per them. So sometimes, just kind of exploring your market, seeing what houses are selling for, but having a general idea of what your house is worth can help us when we're doing math. If you know your interest rates, your balances on your different accounts. And then I always like to ask, and a lot of people don't have this, but what are your goals and plans, right? Is the goal to sell this house in 2 years? That's going to change my guidelines and my recommendations than if this is a 10 or a 15-year house. So just kind of doing some self-analysis and discovering where am I in my journey? What am I trying to get to? People always ask me like on purchases, how much should I put down? I don't know. Do you have enough cash to buy all the houses you want to buy? If you do, put more down. It's going to improve your cash flow. But if you've got a goal and limited access to assets, we need to adjust accordingly. So just having some of those deeper inner thoughts of where am I? Where do I want to be? And then just having some basic data about the assets you have. I usually send investors, especially homeowners less so, but investors, if you've got 3, 4, 5, 6 properties, I love to have a spreadsheet. What's the address? What's the value? What's the mortgage? What's the rate? What's your income? What's your insurance bill? What's your tax bill? So we can see globally where your assets and where your properties are at, because I can't give you good advice until I have a better picture of where you're at.
Yeah, this is good advice, whether you're getting a loan or not. Like one of the things we're working on in RPM and just the rental systems, I have this thing called a KPI spreadsheet, key performance indicators. And tab 1 is like my current cash flow month by month on all my rental properties, like aggregate. But then tab 2 is like all my rental properties and the value of the property, the debt amount, the payment every month, the taxes, the insurance, like that. That's just a good thing to have up to date all the time. And, you shouldn't, in an ideal world, wait until Bryan, your mortgage broker, asks you for it. Like this should be something like if you're an investor, you should be doing this all, every month, at least every quarter, keeping this thing up to date. So if they do that, Bryan, they have like this spreadsheet with their properties. They've got an idea what their goals are. They've written down why they're doing this. Is there anything else they could do to make sure they're like the best borrower possible when they come and talk to you?
Yeah, I mean, income, if you know your W-2, we know your income. If you're self-employed, having access to your tax returns so we can do some tax return math. So the way we're going to help you decide how to move forward is how can we underwrite you, right? Your credit score, your interest rate, the loan to value we're tapping into, how easy it is to verify your income, or it's impossible. And Chad, sometimes the best home equity line of credit is selling the house because you do keep some equity in that home. So I'll have a conversation with people and they'll say, well, should I tap this house? My answer sometimes is, how much equity are you leaving in this house? And is that where that amount of assets should be sitting? If you've bought a house and it had a great run and it appreciated fantastically, but the neighborhood stabilized, you may not have the upside for the next 10 years that you did for the last 10 years. And to your point, if you're not tracking that and you're not analyzing that, you have no idea. You don't know if this is the best place to have some of your assets resting and unemployed, because we're going to leave some unemployed Benjamins in every single house. Is it the right house to have those unemployed Benjamins? Sometimes, man, I can't get the equity I need to out of the house. I should sell it and redeploy that equity into new homes. I talk a lot of people out of doing refinances because they're trying to make something work. They're trying to fit that round peg into a square hole, right? Or the square peg into the round hole. Sometimes we need to prune this puppy and let it go so that we can redeploy with kind of a fresh sense. But if you're not tracking it, you can't tell how different assets are doing with no information. So I love that you guys are focusing on that. It's so important to be able to analyze your current portfolio.
Well, what's fun about partnering with you, Bryan, and getting to work with you is I really love this consultative type approach to mortgage lending. You need a mortgage broker who's going to say, actually, I don't think you should do this loan with me. Like maybe you should just go do this other thing. Like that doesn't happen every day. And it also doesn't happen every day that you have somebody who's in the investment weeds as well, who has their own investment properties, who's talking to other investors. So Bryan, really appreciate you spending your time helping us out to understand cash out refinances. I'm going to put a link to everything you say here for how people get in touch. I just want to say up front though, that Bryan is the person I go to talk about mortgage lending. He's the person I recommend to everybody. He's a partner of the Coach Carson platform. So Bryan, how do people get in touch with you? What's the best way they can connect with you if they want to try to get a loan as well?
Yeah, so we're going to put a link on here that's a request for an appointment. And I'll be honest, Chad, you are a popular guy and your channel gets a lot of views. So usually when these videos first drop, I get a backlog and I've got a team of people that try to help me connect and reach back out to you. But when you first put that in there, if the video just popped, just know it might be a week or two, sometimes 3 if I've got a crazy travel schedule like I had over the summer. My apologies, but we're sometimes going to be a little slow to respond. You can always stalk me and get my direct contact information, but the best way to do it would be to put that request for an appointment on the link that we're going to put on the video.
Got it. It's worth the wait, folks. It's going to be a good connection when you get there. I'll have a link there. So it's basically a form that you fill out. You put your information, and then their team will be able to get back with you and set up an appointment. You can talk and get a little bit more details. So I will put that in the link. If you're in the podcast, you can look in the podcast description. The YouTube, you can look on the YouTube description. And we'll also have a show notes page for this episode, and you can check it out there. So Bryan, thanks for your time. I know you got to get back to talking to some of your clients and getting some of these loans closed. So appreciate you being here.
Man, it's always good to talk to you, Chad. Thanks for having me on, man.
If you like this episode with Bryan about cash out refinances, I think you'll love my next episode about another investor tool called DSCR financing. It's a way to get unlimited 30-year financing as an investor without the need to prove your income or show tax returns. If you're watching on YouTube, just click on the thumbnail above me here, or if you're listening on the podcast or watching on YouTube, you can click on the link in the podcast or YouTube description below. Thank you so much for watching. I'll see you in the next episode.